Welcome to the Capital Discussions Road Trip Trade Alerts monthly live Q&A call. I'm Tom Nonamaker with Dan Harvey, but before we get started, just the standard disclaimer, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So that's the standard thing, and just remember, for educational purposes only. So with that, where should we start, Dan? Should we just go over the trades like we normally do quickly and then answer questions?
Sure, you already have that up there, and then we've already had two requested questions that I said I would answer, and I apologize, I forgot who asked them now, but one question was, which we've addressed once before, but we should probably do it again, how we set up and evaluate and make a decision on a new trade. So I'm prepared to do that. And then another question, which maybe you can address, we both do it perhaps a little differently, and that is when you have a more complex type of position, perhaps one that you've layered some stuff on, how do you exit that? What's the best way to exit that? I think you and I do it in a similar way, but I'll take the first and you can take the second one maybe.
Yeah, that sounds good. All right, so I think I've got all of our positions here. All right, so let's just run through these quickly. We'll start with SPX. This is the July 29th expiration. And for those who haven't seen it, perhaps, we have these nifty planning notes now. And they show up on the home page and also on the class page, you've probably noticed. But the ones we've got right now for yesterday are here. And it's a nice overview. I like the way you did that, Dan, with each trade that's open, just, short notes. And I've actually had people comment to me that they'd like to be able to just quickly see that and know what's going on at a glance.
Okay, so I will continue. Yeah, I'll continue to do that in the future. And then, from time to time, I'll also maybe include some other things like the GARCH volatility forecast and skew numbers or anything that comes up. I follow power options, and it has its own market sentiment that it looks at some, I think, 13 or maybe 14 technical indicators, and I periodically will summarize them also.
Okay, so let's see. Here's the July 29th SPX trade, and it's expiring this coming week. So we can see the probabilities are basically zero for the probability to touch. And we're 1, 2, 3, 4, 5, maybe 5 to 6 standard deviations from the downside break even. So this is one of those we're just going to let expire and fade away into the sunset, unless you need the margin. I don't in my account. I don't think you do in yours. But if anybody else is kind of shadow trading this on their own, that's up to them. But you could certainly close this and free up margin if you wanted to, because you're basically not going to get much more out of this. 943 is the max at expiration, and we're at 910. So you're just talking slippage and commissions at this point. Any other comments on this one, Dan?
No, that's it exactly.
Okay, so the next one, it's weird our option view doesn't do these alphabetically, but I think I'm not sure why they do that. And I'll go back to my blue because that's what I like. Okay, so this one is our August 19th trade, which is the one that we had the two protective puts and the Brexit, and this one got into trouble early and never really got out of trouble. And again, this one is going to coast into expiration. We're 1, 2, 3 to 4 standard deviations from this downside break-even point. I don't think we're going to get down here. Probabilities of touching the short strike, which are higher than that, are 0 according to option view. So very, very, very low. And again, this is one of those that you've gotten all the juice out of the lemon or the radish. So if you need the margin, you can certainly close it. But at this point, we're just monitoring it and just going to let it expire in 28 days.
Yeah, this one was a lemon, and what might be interesting for any of the subscribers that really like to backtest. I don't really have time to do this. I rarely backtest anymore. People who know me know I'm retired. I'm an old guy, and I do the least amount of work that I can do. But for subscribers that are really interested, it might be both fun and informative to try going back and using a debit spread instead of the protective put prior to prior to Brexit. Identify the same day when the protective put was filled, and instead of that, use a fairly wide debit spread, and then when we started to rally back, then either close that debit spread or go ahead and convert it into a put credit spread by, obviously selling the long put and moving it down below the short put, and see what you would get. That might be instructive.
Yeah,
I suspect you would get. I'm about 90% certain you'd get a better result.
Yeah, and we're, this trade is a work in progress. So, if we find better ways to do things in the future, then we're going to do them the better way. So, we tried to protect the put this last time. Maybe it wasn't the best choice, but next time we'll have a better choice.
Yeah. Well, we were really, we were sort of concerned. We were very concerned, in fact, about the effects of Brexit, and so we were hitting it over. We were trying to hit the trade over the head with a hammer, and maybe we should have used a soft rubber mallet.
Yeah, we had this big thrust down with a continuation bar, but it's hard to say if it's going to snap back like it did or just keep going. So, this time the protective put hurt us, but if it had kept going, it could have been a hero. So you just never know. So the next one is this one doesn't actually all fit on here. Sorry about that. Let me back to the blue. Okay, so here's our 2 standard deviation range. That's expiration, which is the most conservative. But if we just put in a T25 line, that would be our first target exit. And you can see the nice little lift we get here down in this area. I always like to notice the expected return in option view. So just for the sake of argument, if you look at the expiration, option view is estimated an expected return of 996 and 936 before, so it's pretty close. And if we do get a little pullback, that would be a nice lift to the profit. I don't know if we're going to get that the way this market's going. Seems like every time it pulls back, it's just a chance to go long again.
Well, that's right, Tom. Exactly. I don't know what's going to happen here, but one of the reasons that I layered this on is that it seems pretty obvious that our initial trade will be profitable, and I wanted to, we still had plenty of time left, and I wanted to do something to maybe bring in a little more profit if we do get a pullback. And so, as I mentioned in one of the emails that I think I sent out, we need to be very careful if we layer on either an unbalanced condor or a small lot butterfly, which are my 2 favorite. And we'll just take the example of a butterfly here. It needs to be cheap. You will be adding a little more margin requirement, but you don't want to pay much for this butter, because if we keep going up, then you have something else now that you have to deal with. So it needs to be really cheap. And one other comment about the expected return on option view, and I haven't looked at this in several years, but my understanding is the way that this is calculated is the software chooses, it was either 6 or 8 or 10 points on the payoff graph. obviously they can't get all the points, obviously, and it's not going to try to do an integral type of function. So it chooses 6, 8, or 10 maybe points on the P&L curve, and that is what it uses to calculate expected return. That's my understanding.
Yeah, I thought it was like 10 or 20, but it slices it up and tries to estimate it.
Yeah.
But it's always interesting to see what the effects are from my adjustments with the expected return. I don't know why I
Really.
like to.
Yeah. Go ahead, Tom.
I'm just gonna say it just gives me a feel if what I'm thinking of may help the position or not.
Well, right, and I think it's a good tool. And frankly, I'm not sure why they stopped at 10 or 20. I mean, this is software. I mean, it's not going to chew up RAM or something. They should have had 30 or 40 points to get a really accurate, or more accurate, I should say, estimated return. And for any subscribers who don't know what we're talking about, there's lots of articles on the theory and calculations of expected return. It's all probability based. There are a lot of examples using a casino game. I have talked about this not at Capital Discussions, but elsewhere. Some of you may have access to that, and so you could review the concept of expected return.
And just a little option view tip: if you didn't know this, if you hover your mouse over this y-axis, you can left click and drag up and down and zoom in and zoom out, basically. So if you want to kind of see where these lines, what they're doing, you can just kind of do this kind of thing and kind of make them a little bit more separated so you can see it clearer. So just a little option view usage tip.
I didn't know you could do that. So you went on the y-axis.
You just go on the y-axis. Notice the cursor changes from an arrow to a double up and down arrow.
Wow.
See that?
I didn't know that.
If you left click and drag, you can change that axis and then kind of magnify it essentially.
Is that relatively new? Because I don't recall that.
Oh no, that's probably been there a year. It's
well,
one of those things. That's one reason anytime there's a new release of Option View, I always read these release notes because there's always little hidden gems in here.
Well, see, I never read them, and
yeah.
and 1 year is new to me since I've had Option View since 1994. So
right.
It's 1 year is new to me. And by the way, I see we're getting a lot of questions in, and thank you. Keep them coming. When we get through with our presentation, we'll go back and we'll try to answer all of them. Right, Tom?
Yeah, absolutely. Okay, so this is our September 16th trade. This one actually looks pretty nice. I think you reversed Harvey this on Friday.
Yeah, and I'll do it again too.
So at this point, the upside expiration is actually above zero. And boy, look at that nice T plus 26 line. Doesn't get much nicer than that. So I think this is going to be a nice trade, especially if it pulls back.
Right. And so again, for newer subscribers who may not be familiar with butterflies in general, or at least the way that we structure them, I mean, first of all, there are many ways to make a butterfly. And we're obviously not going to go into all the possibilities. But the reason that they're structured the way we do it here is we are trying to make some money if the market continues on a sustained rally, and we do this by the reverse Harvey methodology. We continue to raise the right side of the expiration curve as the risk decreases, as time passes and the risk decreases. But we are still hoping for the market to pull back. And basically, Tom and I both, we trade the graph. The graph, only the expiration line is going to be mathematically true, but the other curves are going to give a fairly accurate, reflection of what's going to happen. Now, not on the same day, because if we have a pullback, if it's, say, moderate or even fairly marked, the volatility is going to be talking. So on that particular day, you're going to show a P&L loss. So if you see that, don't say, well, Dan and Tom have no idea what they're talking about. They said if the market pulled back, I'd make money, and look at my P&L. I'm down today. Well, you're likely to be down until the volatility comes out. But the curves are otherwise, even the hypothetical curves are reasonably accurate as to what you can expect when the volatility comes out and when time passes. So that's why I say I think we both like to trade the graph more than the Greeks. We look at the Greeks, but I look at the graph.
Yeah, I do too. I look at where is the spot price, the underlying in relationship to my tent, and where is this expiration P&L? Do I need to keep raising it? How far or fast is this turning into a slippery slope that I want to stay off of? Things like that. So yeah, the graph to me again is the primary. It's like when you fly, your primary reference is the horizon outside. You're not your instruments inside when you're flying visually. So this is kind of like flying VFR. This is our horizon, if you will.
I like that.
Yeah. Okay, so that's and this might be a good one to come back to of how you would close something like this. Once we get to that point.
Okay. Sure.
The last one we have is the September 30th. This is our newest one. And again, this is still in its infancy, so this looks like, pretty much we just started it, which we did. And it's only down a couple hundred, but, there's still 70 days to go. So, again, we don't want to reverse Harvey too early because then that starts turning it into a put credit spread type of the shape where this starts falling off. And we don't really want to do that with so much time remaining. We want to let a little time pass and let the theta do its magic. But for now, even if it starts running up to the moon, the most you're going to lose on this is less than $500. So
and we're not going to lose that.
No. So that's just today. If the aliens landed and they're friendly and the market goes to 10 million, you're going to lose $500 on this trade.
Yeah.
So that's the worst case.
Worst case, yeah.
Okay, so the Russell, we only have 2 trades, I believe. And let's bring those up. Okay, this is similar to that SPX August 19th, same expiration, but you get the idea. It's going to coast into expiration, and we're just going to monitor it. And the premiums are shrinking and shrinking on this. If I do the probability of touching, it's 2% for the short strike. And you can see that with the standard deviation being the 2 standard deviations are down here, which is above the short strike. So the odds of this actually getting down into this region are extremely small, and especially given the market's on a tear to the upside. I think we'll just watch it and kind of let it fade away.
Right, and you could do the same exercise on this using a wide debit spread instead of a protective put.
Right. So I think we've already kind of talked about that for SPX. It's a similar trade, really.
Yeah.
And the last one we've got is our September 16th Russell trade, which looks like this. The expiration P&L is minus 70 up here. So again, it's very, very close to zero. If we go for, let's see, T41 would be 15 days before exit would be this line. So, if we do pull back, we can generate some nice profit in here. We just have to be careful if we reverse Harvey, it starts pushing the potential down. So it's kind of a balancing act with reverse Harveys. Yes, you raise this up, but then you also lower the amount you can make if it pulls back.
Right. So it's going to be very gradual. I mean, I do anticipate doing the reverse Harvey at least one more time, but for the reasons that Tom mentioned, it needs to be very gradual because we don't want to give up the possibility of making 8 or 10% on this.
And it definitely exists. So those are all our open positions. I guess it's time to start looking at the questions that people have.
Yeah, I mean, while you're right on option view, if you wanted to go back now and to that one trade and show how we would exit that, maybe while we're right there. and then we can
Oh, that's
start.
September.
Yeah, and then we can either do questions, or I can do the question about how we set up and evaluate.
Okay, sure. So here's the, I'll put the trade column here. Here's that one September 16th. It's got a lot of extra strikes up here. So, somebody sees that, they're like, geez, okay, it's time to close it. How do you do that? Because it is a lot of strikes.
Yeah. So you have a pretty big inventory of trades, but as Tom will tell you, it isn't that difficult to figure out how to close this.
What I'll do is typically I'll start taking butterflies off, and you monitor your delta too. Now in option view, if you've got your matrix set wide enough and you have existing and trade column entries, it'll have like a before and after. So for instance, if I wanted to close this butterfly, something like that, it's going to show me the existing and the both. So here it doesn't really change my delta much, and then I can go into um, the analyze chart and superimpose them, and you can see it doesn't really change my risk if the market's moving while I'm doing this. So then I would try and close this butterfly. If I couldn't get filled as a butterfly, then I'll just break it up into two verticals. So I'll try and get this one filled, and then this one filled. And again, if you're just monitoring that existing in both column for your delta, as long as you're not getting too positive or negative delta, you don't really need to do anything. If you're closing a bigger position, like say maybe a 4 lot, something like this, and they're not filling the butterfly, so you do something like this. Well, now you've got a 21 delta, and if the market's quiet, that's probably not a big deal. If it's bouncing around a lot, then you might want to hedge that off. So you could do something like buy some spiders, like say 20 shares of spiders, or 200 actually, and then that would hedge you off to about almost a zero delta. And then as soon as that, we'll say you get this fill, put the spider on, and then you do the other half of the vertical, and then take the spider off, and that would keep your deltas pretty flat the whole time. The spiders obviously are going to get filled right away, so you don't have to worry about market risk if you do it that way.
Right. The spiders are very liquid, and you'll get an easy fill on that. Usually, maybe give up a penny. Uh, they're very liquid, and you can, as Tom said, you can put them on and take them off as you need them. And but it is always a good idea to start with trying to get a butterfly filled. And the way to identify when you have a fairly big inventory of trades like this, a newer person might say, well, where's the butterfly? How do I know that? Well, you look at the short strikes. So you see a minus 10 there, for example. You know that that's a part of the butterfly. So then you look on either side, and you'll see the components then of the butterfly. So the easiest thing to do, if you have a 10, as Tom showed you, make it a 4-lot butterfly to take off, and then you'd have 2 shorts left, so you would take them off, and then you're going to be left with some verticals and a small lot butterfly. So it's really pretty easy. It maybe takes a little practice, but once you get the hang of it, you can do it very quickly. And what I do is I simply queue up the orders. So if I were to take off a 4-lot butterfly, I need to remember that I'm only going to have 2 of the original 10 shorts. So I will queue up another order to take them off, maybe as another butterfly, because there's a 1 and a 1 on either side of that, and I will queue that up. And you'll eventually get them filled, and then be left with just a few verticals, which will fill easily.
Yep. And you try and balance them. So if this is 4, you look for 4 over here. In this case, we don't have 4 at any one strike, so you probably want to do 2, and then 4, and then 2, get that filled, and then do another 2 here, another 4 here, and now maybe do this one. And those will be gone, this will be down to 2, and that'll be gone. And then you're just starting to whittle it down.
Yeah, I'm sorry. I have to apologize. I didn't have my glasses on And I thought that there was a 4 on the other side there, but I see now it's a 2. But anyway, you get the idea.
Yep. Okay. Let me bring up the chat. Let's see.
So, folks, sometimes when I'm putting on a trade, I don't have my glasses and I just kind of, throw darts at the screen and see what comes up. No, just kidding. Just kidding.
I was on a lot of dart teams in Chicago before I joined the Air Force. I can throw the darts for you, Dan.
Yeah, okay.
Okay, so let's see. One of the best pieces of advice is thinking about the protective put to the downside. Can you walk through how you think about putting on a spread instead of a naked put? I guess not a naked put, it's just a single. Did you want to talk about that, Dan?
Well, sure. I mean, basically, you sort of do it the same way in the sense that you decide from using the wand function of your platform, Thinkorswim, OptionView, whatever. You decide by looking at the Greeks and the P&L at various points on the downside using the wand function, and you determine a point at which you would want the market to, not the market, you would want to put on a wide debit spread. And I refer to this as being the trigger point. And so generally, I don't want the total position deltas to get too long, and I don't want the slope of the T+1, or we'll say the T+3 curve to be too accelerated. So I'm going to pick a point, and that's going to be my trigger point, and then I choose a debit spread that's going to cut the total position deltas roughly by half, at that point, and it's also going to flatten out the T+3 or T+5 line. And there isn't any mathematically pure way to do this. It's kind of a trial and error thing. But even if you're wrong, you're not going to be wrong by much, and you're still going to protect the position because, remember, if the market still continues to go down and we're getting beat up and there's enough, and we still have, we'll say, maybe 30 days left, we're just going to take that off and maybe reposition it. We're not going to have more than, we'll say, a 6% loss. Really, I don't like to have more than a 5% loss. I went a little bit higher because of Brexit, but generally, I watch this very closely. So the purpose of the protective debit spread or put is simply to buy a little more time while the market is settling down. And like I say, if you're a little off on your estimation of the debit spread, it's not a big deal, because if you had to, you can add another one or you can reposition the debit spread. But you just want to flatten out the T+3 curve or T+5 curve, within the range of where you think the market might go, and you want to cut your total position deltas in half, roughly at the trigger point.
Okay, I see another question about what do you use to determine when or at what point to layer on a butterfly or condor or a put vertical or any other trade for that matter?
Well, I'll tell what I do, and then you can comment on it, Tom. I mean, the reason I like to layer it on, and I didn't do this when we first started or when I first joined the road trip service. Tom had already started it and did a great job. Didn't need me really, but I was glad to come aboard. Anyway, when I did come aboard, I didn't want to do it because I wanted to get a feel for the subscribers and how it was going to work. So I didn't really do it, but I did it in my own account. And so then I thought, well, what the heck? Let's just go ahead and add the layering to the subscriber service. And the purpose is when we have a sustained rally And we know we're going to make a little money by doing the reverse Harvey, but we would like to make a little more, and we would like to do it at minimum cost and a minimal margin addition and minimal risk. So those are the primary determinants of when I'm going to layer and what I'm going to layer on. Usually I will try to layer on a small lot butterfly, but if I absolutely cannot, I will do an unbalanced condor. And by that I mean if I'm short total position delta, which I would be after a sustained rally, I'm likely to add on a condor that might be a 2 lot of the put credit spreads and a 1 lot of the call credit spreads. And I'm trying to bring in a little more premium with minimal cost, minimal margin requirement, and minimal risk. So I'm not going to use a very high short strike delta on that on the unbalanced condor. Maybe an 8 or a 10 is about all that I will go to because I don't want that to be hit. So that's the rationale behind that.
And I know one thing you don't really do this, but I like to do this sometimes. Is I'll also add in some long spiders to adjust my delta. So just I did this the other day in my own account. So here's what my two open positions look like. They're both road trip trades, and I've got an embedded put vertical on one of them. But I think the market's going higher, so I just bought a little bit of SPY and just changed it to this. So it just kind of essentially, if I superpose it, rotates the whole risk graph essentially at the current spot price, and just a little bit of a tweak. So I'm more bullish. We're not going to do this in the class because we want to stay more neutral. But personally, I'm a little bit more bullish, and I wanted a little bit more money if I'm right if it keeps going up. So that's another kind of layering you could do, just adding some or shorting if you're bearish, some futures or the ETF to just kind of rotate things a little bit. But it's very flexible. You can do all kinds of adjustments like that. We even talked about a combo trade.
Well, that's right, and yeah, Tom's going to show the combo trade in a second. But the SPY is a very good thing to do, and I do buy some SPYs. You can't really short SPYs in an IRA account, but you can buy SPYs, and of course, it's going to cost you a little more money, but the reward is usually worth it. Certainly would be worth it if the rally kept on going, and if it didn't, the SPY is so liquid, you just say, oh, what the heck, I'll just go ahead and dump this. I'm not going to lose much. Or you may just want to keep it and maybe hold the SPY as a longer term investment. Generally, I buy spiders and a TLT. Those are my two main ETFs that I buy when they're beaten down. I buy a lot of them, and when they've run way up and look like they're rolling over, I will buy some long dated puts. But I don't usually incorporate them directly into the road trip trade like Tom did here, but it's a good thing to do. And I think he's going to show you the combo now.
Yeah, so basically the idea is if you're bullish, which I am overall for the market, a combo trade, if you just look at it by itself, is a long call and then you sell a credit spread to pay for it. So in this case, I'm selling at $10 and buying at 4.90, which is a little bit over 5, and I'm paying $5 for a call. So just that combo by itself would look like this. So it's basically no cost at this point. But if you're right, you have a long call and you have a long way before this happens. Now, the bad thing on this kind of trade is if you're putting on a combo in the markets and you're wrong, now the call is going to lose money and this put vertical is going to lose money. So you got two components working against you. But if you combine it with the road trip trade I've got on, it lifts this whole thing up. So if I'm right, then this will just keep going up. And because I put this at or near the short strike, it doesn't change this part of the graph too much. It obviously increases the margin. So if I compare the two, it is a bit of a margin increase, but The T plus N lines aren't too different, and you can defend it if it does start going down. But it does give you a nice lift if you're right. Here's 1.5 standard deviations is quite a difference. So that's something I was thinking about doing. I haven't done it yet, but I was thinking about it, and I thought, well, people should know about it. It's a good trade, the combo trade, if you do have a directional opinion. And again, that's another type of thing you can layer onto an existing road trip.
Well, that's right, and I do combo trades in my PM account because they don't use much margin at all. And if you structure them the way that Tom showed you, for this particular example, using the put credit spread to pay for the long call, that's the way to do it. And if you do it in a PM account, it doesn't really do much to your margin at all. But as Tom mentioned, you do have to ride herd on this and take it off if you're wrong. And by the way, I noticed that Steve mentioned you can buy some SH, and that is one that I also buy. And so basically, that's um, a bearish type of ETF. So when the spider has run up a lot, you can just buy some SH, and that's something I do also quite frequently.
Okay, it's going down the list of questions in the chat. Joseph asked, how would you build a portfolio of trades when starting with 20,000 of capital? Personally, what I do is I look at how much margin do I want to use, and normally it's 75 to 80% maximum. So just for the sake of argument, I would have, say, 15,000 of that 20 that I would actually trade with. And then if I'm going to use, say, $5,000 in a trade, I would put 3 trades on and spread them out every like 3 or 4 weeks. So you get that time diversification, and then you're not using too much of your margin. You still have some dry powder, but you don't have to do every trade that we do or every expiration cycle, but you have to size it according to the capital that you're trading.
And I would do it the same way. You might not be able to do every cycle that we do, and you are going to have to cut your size down a little bit. But my recommendation would be to still have a reasonable size, like say a 5 or 6 lot. Now, obviously, you can trade, and we've shown this in the past. You can trade a road trip with only a 1 or 2 lot, but it doesn't leave a lot of room for adjustments, and you don't really make much, unless the market drops back into the 10. But if you have a 5 or 6 lot, you can make some actually very good returns, and you can make some of the adjustments that we make just in smaller size, but you won't be able to do every cycle if you're starting with a 20,000 in total capital. So I would recommend missing a cycle or two, but concentrating on doing a 5 or 6 lot. What do you think, Tom?
Yeah, and it depends on how much margin you're using. Like, I like to use a little bit wider road trips, so they're a little bit bigger debits. So I tend on the small accounts that I'm trading, I tend to have 2 or 3 on at a time, and generally 3 to 5 lots, and then the amount that I'm trading is maybe a fourth of the total account for each position, with 3 maximum on at a time. That seems to work pretty well.
Yeah.
Okay, let's see. Next question is from Greg. What are the reasons and pros and cons of different structures you may choose to layer on? We've done an additional butterfly, but you mentioned unbalanced condors, etc. Well, I guess probably depends on your market outlook, and what happens after you put it on. I think here you put, let's see, which one was it? The Russell, I think, or maybe it's this one. You had a 1 lot butterfly, the market moved, and then you added another one on. So you're kind of constantly tweaking it as it goes. It's not a static thing.
Well, right, and that's the reason I did this as a butterfly rather than unbalanced condors, because I, like everybody else, and we may be wrong, but we keep thinking that at some point there's going to be a pullback. So I'm looking for that pullback and hoping it happens. And if it does, and if it's moderate, will drop into those butters. Uh, Unbalanced condor, if you're far enough out, would work. They tend to use a little more, maybe, well, if you use like a 2-lot put and a 1-lot call, they tend to use a little more margin. And the maximum return is fixed, whereas with the butter, well, obviously maximum return is fixed, but you have a broader range of maybe higher profitability than you would see in a condor for the same margin. That's the reason that I like to use the bearish leaning butterfly, or actually bullish leaning, because we're actually hoping it will drop back into the butterfly.
And honestly, you can do almost any kind of adjustment on these layers. So if I go back to that one trade I've got, let's see this one, which is pretty flat. So if we wanted to do something like, let's see, where's the market up here? We could even sell a butterfly. We could do something like this. I don't even know if the strikes are right. Let's see. 20, 25 is 15. Well, it's a little bit unbalanced, but that by itself is a short butterfly, something like this. Probably not the ones you'd want. Maybe something like that. Well, that's anyway. It's pretty narrow, but you get the idea that if you add this with your current position, it makes a little dip, and the bigger the strikes are, the more credit you're going to get. So it's going to lift this whole thing up, except this little valley here. So if you don't think the market's going to stay in one place, you could sell butterflies on top of a road trip. So be creative. You're not limited to just a long butterfly and an asymmetric condor and a put vertical. You can be pretty creative with this layering.
Well, right. And if you if you did decide to sell a butterfly, as Tom said, instead of buy one, if you keep the spread widths relatively narrow, the margin won't be that much extra. I didn't see what the margin was for the one you showed, but it won't be that much extra.
Yeah, it went from like 41 to 44. So
yeah.
And again, in a PM account, it probably wouldn't even change.
Right.
Okay, so let's see. Next question. Brian says for the August 19th, he assumes there's not enough time premium left to add any layers. Oh, I'm pretty sure that's right. Let me go back to.
Yeah, I've looked at it. I couldn't find anything that was attractive to me. See what Tom says about it. I couldn't find anything that I liked. I looked at a few things, though.
Oh, and we can even put time premium in here. So we have a little bit, but the problem at this point is, okay, if you reverse Harvey this, that's 17 cents, and what does it do to your margin? So it's getting to the point where the slippage and commissions are going to be actually a pretty significant part of any adjustment, because you're just not getting anything to work with here.
You could layer on, a small lot butter and maybe, pick up an extra $100, $150 if we drop back into it. But again, you need to find one that is pretty cheap, because if you wind up paying for, we'll say $200 for that butterfly, there would be no time left to reverse Harvey that butterfly. So you'd give up some extra money that you wouldn't have lost to begin with. So the amount of time remaining is sort of critical in these things, which is why we choose a fairly wide window, 70 to 80 days, to start with, and because we want to give ourselves, plenty of time to make whatever adjustments we need, and to keep the T+0 line flat and still wind up with a profit on nearly all cycles, except when we have something like a Brexit.
And for this one, I was thinking possibly we could just roll the whole thing up, which you could, but now you're basically closing this position and opening a new one, but that's not really what we do. We don't open these trades with 28 days to go. You certainly could. It's certainly possible, but that's not the way we normally trade these. So, if you do roll it up, you'd have to be pretty careful. You don't want to get too close to the head of the snake, right?
Well, that's right. And I think if you found that if you did that, and of course, Tom and I both have been trading many years, and we both have done this, and I think we have the same shared experience. It just is not worth it. You might get lucky and make $100, after commissions, but you might get hurt. Market might pull back faster than you thought. Volatility cranks up. You've already spent a lot of money now on commissions, and you go back and analyze everything, and you say, well, this cost me $200 to do this. Why did I do this? And that has happened to me, so I don't do that anymore.
And if on a typical road trip you're starting out with a short delta of, say, in this range, say the 25-30, you're talking about 21.45 on this price chart, which is up here. Now, what are the chances that we could just have a little bit of a sell-off and get down into the 21, down in this area? Well, that's SPX. It's run up quite a bit, and to me, the risk of it coming back, because we are kind of overbought, doesn't really justify rolling the position up. But if you're a gambler, I guess it could work. If you use teenies or something. But for us, that's not really how we trade. Okay, so next, Morgan. Hey, Morgan. The horizontal axis of the equity curve is trade number. Can you also add a time scale below? Could we add? Oh, that's a little bit of work. I guess we might be able to do that. Now he's talking about just some tweaks to the class page, I think. So the returns on planned capital and total account equity per month. I'll save your comment, Morgan, and then I'll go over it. Let me just put it in another note for myself. Okay, Mike says, Dan, do you use TOS Greeks and graph though, right? So he's asking, you're using the Thinkorswim Greeks and Analyze chart. I think you do.
Well, I do. I use Thinkorswim to set up the position, which I will show in a minute, and I follow it on a day-to-day basis, real time. But at the end of the day, I look at option view just like Tom does, and also I use the spreadsheet from Rahul, which I have found to be very accurate, and I use that in my PM account because I don't really have the time to transfer over all my trades into option view from both accounts. So for the class account, I transfer the trades over to option view, so my graphs will look like Tom's. And for my PM account, I use Rahul's spreadsheet calculator to get my real-time P&L. And it works, very well. And there's a link on the. I looked this up for somebody today for one of the subscribers. I think the link is on April 27th, and then I think he came on Capital Discussions Trading Group 2 on April the 29th and explained how to use it. And once you get the hang of it, it's just real fast. So those are the things that I use to monitor and assess my positions. And let me just mention one thing. Sorry to interrupt you, Tom, but I did want to say this. The question that I got was actually something along the lines that the Thinkorswim P&L doesn't match the option view charts that Tom shows on the images. The reason is the Thinkorswim platform, when you look at the risk graph on there, on the Thinkorswim platform, it is only looking at the open positions. It does not take into account, any positions that were adjusted. So if you did a reverse Harvey, if you repositioned something, So so whatever you took off, it's not going to show that. So you have to have something else, either Rahul's spreadsheet or option view or one or build your own spreadsheet or something. If you want to have an accurate graph that actually reflects your true P&L. The shape of the graph on Thinkorswim will be accurate. That will in fact be the shape and configuration of your position, and the relative spacing of your day step curves, your family of curves, will be accurate, but the actual P&Ls will not be accurate because they're not going to reflect any adjustments that you've made.
And essentially, all you're doing is the previously realized gains or losses, like you see up here in option view. You need to just account for that in Thinkorswim. And when I had a Thinkorswim account years ago, I would add a long and short option of the same one that I wasn't trading, set them to a zero price, and then as I started getting some actually realized gains or losses, I would quote buy or sell these options so the risk graph would be shifted up or down appropriately. And I had to keep track of that realized gain or loss manually, but that's one way, kind of a pain to do it, but it can be done.
Yeah.
I think other people keep the trades that they've had in the simulated trades, but then you have to keep track of which ones were actual trades that you had versus ones you were thinking about. And I think Jim Riggio uses a lock or something to show which ones he's actually done versus which ones he's thinking about. So you have to develop your own little tricks to make the toss risk graph look right.
Yeah, you can do that. And when I was mentoring, several of my students would do that. And the ones who were good at it, it was no problem. But there were several that maybe forgot one or got a little confused. And then they might have had 8 or 10 simulated trades that they had to bring in. And the graph didn't look right because they had left one out. And so if you choose to use that method, please be very careful because you can get a risk graph that may look right to you, but it's actually not. And if you make a decision on it, based on that risk graph, it may be very wrong. So if you chose to do that, please be careful. But I would recommend if you did it that way, that if you were going to use Thinkorswim and try to make the graph look right, I would use Tom's method. And I see Steve also commented that he makes a correction with a dummy vertical with the same strikes. So it's very similar to what Tom said.
Okay, and then Joe asked, are we aware of any other trades that would complement the road trip? For example, a trade with negative delta that might help if the market moves down sharply immediately after a new road trip is entered. I know, who was it I was talking to? They were using one of Ron Bertino's space trip trades to hedge, and during the Brexit thing, they actually made money on their August 19th trade because of that hedge. So, something like that might be interesting, or teenies certainly work, but again, in the long run, they probably decrease your returns, but on those big moves, they certainly help right away. Any other ideas for complementing the road trip, Dan?
You mean on the downside like that?
Yeah, like a complementary trade that would help hedge for the big down moves.
Yeah, well, you could put in an unbalanced condor leaning the other way with, more call credit spreads than put credit spreads. You could simply sell call credit spreads, but of course, you get, since they only margin on one side, you might as well get a little money from the put. So you'd want to sell a very far out of the money put credit spread and maybe make it like a 1-to-3 ratio between the put credit spread and the call credit spreads. You could do, there are quite a few fancy things that you could do, but they all carry their own attendant risk. And since we try to keep the road trip trade fairly simple because we have, subscribers of all levels of expertise who don't really want to do too much of that. The road trip, the road trip trade, in and of itself is actually set up and designed to make money in the majority of cycles. The win rate should be, 75% or more, and uh, some of these that if you really have a really sharply falling market, you just may not want to be in any trade at that time. You may just want to take a small loss on the road trip trade rather than trying to beat it over the head with a hammer to make it work. I remember many years ago, I had a big butterfly, and I was trading a lot more capital then than I am now because I was younger. And I wound up putting about 100,000 or maybe 125,000 in one trade, and it was a series of butterflies. And I just kept beating the thing over the head, and I wound up making maybe, I don't know, maybe 5 or 10,000. The market just kept going down and down and down. And so after it was all over, I naturally breathed a sigh of relief, but I also thought, this really wasn't worth this to make 5,000, and I, plunked down 125,000 to make 5,000. It wasn't worth it. So I stopped doing that.
Yeah, I've had similar experiences where you keep chasing it and you think I'm going to make this win, but in the end you look back and like, man, I should have exited as soon as I start getting in trouble. So cut your losses and focus on trades that are going to work. Let's see. Mike asked, do we add the vol change in option view to estimate where T plus zero will be on a stiff down move? Yeah, you can definitely do that. Like on this risk graph, here's a volatility change. And here's a 5% increase in vols. You can kind of get a feel of what's going to happen. My vega on this is pretty small, so it didn't change much. But you can certainly simulate a big vol increase by using this. If you want to increase it more than option view thinks it's going to move when the market collapses, and certainly you could try that.
But remember, that's just an estimate.
Right.
Because
it's a guesstimate.
Right, because no software can completely program in the stochastic volatility. The quants have that. The big boys, they have some algorithm that can do that, but the software for retail people, none of the currently available software, to my knowledge, factors the stochastic volatility in perfectly.
Well, and all I know is that when the vols go up, this P&L, if your negative vega, is going down. So, you'll see what it is when it moves. But if you want to try and model it, just crank this up and then try and figure out what your hedge should be. That's about the best you can do.
Well, right. And so going back to the question of how do you determine where to add either a protective put or a wide debit spread, and how do you structure it? You should actually crank up the vol anywhere from 3 to 5 points to see what it would look like, and use that to help you determine the trigger point.
And if you cranked it up too much, then it's going to be an over. You're going to protect yourself more than you thought you would. So, it's better to err with too much volatility cranked in than not enough.
Right, and remember, volatility is mean reverting. I mean, that's the basis of the Garch future forecast. The Garch methodology that I use looks at 4 years of data, and volatility is mean reverting, meaning you'll have some things that come up like Brexit or some geopolitical event of some kind or another, but eventually the volatility is going to seek a mean level, which actually closely approximates the mean for 4 years. And the Garch calculations are mathematically complex, but getting back to what Tom was saying, if you crank that up too much, you're going to be wrong by too much. It is likely not going to hit those points. And when it reverts, or when it begins to revert, just as it did in Brexit, if you recall the chart that Tom showed on the S&P, we had a V bottom. And that's what happens a lot. You get there it is. You get a V bottom. And so you don't want to use overkill here.
In fact, it happened here, kind of happened here.
Yeah.
So like here, these V bottoms happen quite frequently. So that's why I think the debit spread is going to be a better hedge in the long run, because that spread's not going to lose value as fast as a single long put.
I think it will. Yeah.
Okay, let's see. Bodan says, great job on the combo hedges. Thanks. He's interested, but I put the combo hedge out to the community as a trader's choice. Well, how about this? If I'm going to do an adjustment that's not for the class, like adding some long SPY or putting a combo trade on, I'll make a post in the forums, and then you can take that for what it's worth. Free advice. You decide if it's worth it or not. But I'll tell you if I'm going to do something like that, just so then you can think about how you want to do your layering.
Yeah, good idea, Tom.
So Mike says he knows a lot of the downside protection is by feel. How wide of a spread would you build as a protected position for a road trip?
Yeah, well, I mean, again, I choose for the long leg, basically the long leg at the trigger point, and then I choose the width sufficient to cut the total position deltas at that point by at least half.
So if we go like a T3 or T5, something like that, and then if we crank the vols up 5%, let me make this a little bit wider. So if we go, say, out in this area, we would be down like $350. Really not that much.
Yeah, of course, I would have put it on before that area, though.
Right. Maybe like in here.
Yeah, I generally put it on either at the short strike. I mean, depending on what the market tone is. I mean, if the market tone looks like we're really going down, I'll put the long leg slightly ahead of the short strike, meaning on the upside. If it looks like, well, we may just be going down moderately, nothing seems to be in the mill here for anything major, but the market is cranking down some, well, then I'll put the long leg either at, we usually maybe one or two strikes down below the short strike, and then, as I said, see what width I need to cut the deltas.
So like for example, here we'd be down almost 900. So if you wanted to cut that down, you'd have to find some kind of adjustment that would be maybe take it down to 300 or 400, and that you're still losing money, but not as much. And the idea is to keep the losses small. And when you do have a big move like that, we see those V bottoms. There's a good chance it's going to snap right back.
And this is the reason why you don't want to do overkill.
Right.
And when I put on that the debit spread as the hedge like that, once it is filled, I will do the opposite. I will set a trigger point and put in a good till canceled order to take that debit spread off, so that I don't lose too much of the money. I don't like to lose more than about 40% of the debit spread cost. So I usually calculate that in approximately. Again, it doesn't have to be exact. I calculate that in, and I set it up as a good till canceled order, and I set the trigger point, at the point that I would only lose maybe 40%, and just let that order sit there. And if it is filled, then okay, I've lost a little bit on the debit spread. That's the cost of doing business. That's the cost of insurance. But now the road trip is going to be sitting really well. We should be under the tent or near the upper long put of the original butterfly, and we should be in a position now to generate a nice profit from the butter itself.
And I do a similar thing when I put a hedge on like that. I'll just put a GTC order in to buy it back at, say, 70-75% of what I paid for it, and then just let it go. Okay, what else do we have for questions? Let's see. There's so many open trades. Could you add a live field? Second, which show the net. Oh, yeah, I kind of talked about that. Yeah, Morgan, I'll see if I can do something about the net liquidated value of the $100,000 account. I mean, it's not like my live account that I can just look at interactive and tell me what the net liquidating value is, but I'll see what I can do for the class page. See if I can get a similar thing to that. Not quite live, but maybe end of day. And Steve said he corrects his toss P&L with the dummy vertical. Okay, we saw that. Brian, you can hedge with a 1x2 spread. Books called SPS puts. Requires active management. One thing I do like to hedge with things all that I can see everything in option view at one screen. So if I'm trading 4 or 5 different SPX trades, I like to hedge with either ES futures or SPX options or SPY, which is obviously the ETF for the SPX. And I can simulate the SPY by fractional, um, you know, by 1/10 the amount of long or short SPY units here. And then I see a combined risk graph of everything. If I'm using VIX calls or something else like the SH or SDS, I can't bring that into option view, so I can't see it as a whole, my whole portfolio. So that's just me personally. I like to stick with those things for hedging and adjusting just so I can see the big picture all at once.
Well, that's exactly right. You have to be really careful if you do a lot of extraneous things, and particularly if you're trading ES futures. You got to really watch them very closely. I mean, I day trade them daily, just about every day for fun. Lynn and I call it latte money. If I make my latte money, it's just kind of our own private joke. But anyway, I don't try to make a killing on the futures. I used to trade them. I used to swing trade them, leave them in overnight. Don't do that anymore because I got popped really, really good ones. But I would say that if you do you hedge with the futures, nothing wrong with that. It's fine to do that. But please make certain you understand how they work, and please make absolutely certain you can get in and get out very quickly, and that you know your platform, because I'm telling you, if you're wrong, not only will you not be making latte money, you won't be going out to dinner for a month. So you got to make sure you know what you're doing.
For instance, here's one place I could use futures. Instead of doing that, I could do one long futures contract, and then this is what the combined position would look like. So, it's a 50 delta plus or minus with an ES futures contract to your SPX position. So it's essentially like buying 50 SPX. And like Dan said, you got to know what you're doing. If you're just trading the future by itself, it's pretty speculative. If you're combining it with other positions like this and you know what you're doing and the risk graph, looks pretty good, then, that's different. So I guess this depends on how you use it. And Dan, I think that's about all the questions. We had a lot of thank yous and Sandeep asked where can I learn how to trade futures? Well, that's a pretty big question. If you want to trade them directionally, or do you want to use them for hedging? Are you intraday? Is it something you're doing longer term? There's a lot of follow-on questions to that first. Where do you learn about trading futures? And maybe we can talk about that in a blog article or another video. But that's probably too much for this one. Oh, intraday to make latte money. Well, day trading, that's there's a lot of people trying to do that. And
well, sometime, we could maybe the simplest thing would be just to maybe just for fun, obviously not as a part of the road trip trade. We could do a video, a short one on, I could show the way that I day trade them and some, what I look at. I mean, literally, that is an exhausting subject. There are literally hundreds, if not thousands, of YouTube videos. There are dozens of websites that would be glad to take your money and mentor you, and I use that term very loosely, mentor you on day trading futures. Some sites are good, some are crap. You don't want to do that. But I like to do it for fun in the first couple hours of the morning while I'm looking at the road trip trade, because I usually don't stay at my computer all day, folks. I guess you know that. I hope you know that.
Me either.
I try to, yeah, and Tom doesn't either. I mean, we try to be, fairly timely in our answers to your questions and things like that. But I try to get out after the first 2.5 hours after the market's open, and sometimes I'm gone. I'm on a road trip myself, and so I'm doing this from a motel. We're going up to Tahoe in a couple of weeks, and I'll be doing this out of a motel. So anyway, but I usually am sitting either in motel room or at home for the first maybe 2.5 hours of the day, and so I'll often day trade futures. Well, I always nearly every day while I'm doing road trip stuff. So you can have that approach. You can have a swing trade approach. That's kind of risky, but the payoff, if you get good at it, the payoff is really great. But they're all directional trades. I see there are some other comments that are coming in. So the person who asked that question, you might be able to get some information from that. But anyway, at some point, we might just do a video for fun, and I'll show you what I look at, and maybe Tom can show what.
Yeah, I'll show you some stuff I learned from Joe Ross. It's pretty interesting.
Yeah, right.
Yep. All right. Well, I think we're over the hour we normally like to keep it to, but I think it was worth it. Some good conversation. And thanks very much, everyone, for sticking with us. And
well, actually,
hopefully...
wait a minute.
You had something, Dan, right?
Yeah, I promised. I forgot who it was, but I promised him I would answer this. So
I'll be the presenter role then.
I'll be very quick.
Okay.
Yeah. So the question was, how do I, set up and evaluate a brand new butter? And we've answered that once before, but I will do it again. So once before approach, which you can see my screen, right, Tom?
Yep.
I showed you the top-down approach where you basically buy a ratio spread and then buy a garbage put. So I'm not going to show that now. I'll do like a bottoms-up approach. So the first thing I do is I get the at-the-money volatility, and let's see if I can find. So you can use the I volatility like we have on the website, and so if this is a brand new trade, I'm going to set the time. I'm going to make this a custom future date, and we'll go 55 days. So I want to look at what's going to happen 55 days in the future. That didn't do it. 55. Yeah. So the at-the-money volatility is 11. So somewhere, and you'll get something a little different, depending on when you do this. But so this is the lower part of that one standard deviation. So somewhere in this range, I'm going to set the lower leg. So this is getting 2076. So I'm going to set the lower leg somewhere around 2070, 2060, something like that. The short strike is going to be midway between whatever I choose for the lower leg and the current mark. So let me just go in here, and we'll set 2070 here for the 30th September. I don't know that this is going to be the one. Let me get rid of the existing position. So we'll set this for the lower one. And then the mid point would be about 21.26, I think, by my calculations. Now, for the short strike, I go at least 10 points below what the midpoint would be. And again, the midpoint is, halfway between the current value of SPX, which is 21.75, and what I'm choosing for the lower leg. And so I'm going to set the short strike roughly halfway between there, but I'm going to go a little lower. So I'm going to use, I could use 21.20, but I'm going to use 21.10. So I'm going to sell two of those. And now I have to get an upper leg, and I see that the distance here is 40. Well, I know that's not going to be enough. So I'm going to go ahead and make this a 50-point wing, because I know 40-point wing 55 days out is not wide enough. Now I might have to come back and make this maybe 20-50. It all depends. I might have to change this one, the short strike. But anyway, if I have a 50-point wing here, I'm going to want a 40-point on the upside. So I'm going to look at 21.50. We'll see what that looks like. And this would cost $1.75. And so now this is where I begin the evaluation process. I have determined a butterfly that looks good, by the eyeball on additional, on the first glance. What do I mean by it looks good? Well, it is reasonably cheap. Now, I know I'm going to have to reverse Harvey this because I'm paying way too much for this. And we'll talk about that in just a second. But the T+0 line is pretty flat, and it's looking good, to begin with. So now the next thing I'm going to do is to see what the margin would be and to see if I can reverse Harvey this enough to make it a worthwhile trade. And then if it is, then I'll do the final evaluation, and then I'll make the decision. So you can see this is a Reg T account. This is the class account. And you can see with a one lot it's 1,000. So let's crank this up to 10, okay? That would be 10,000 Reg T margin. So the next thing I do, I look at the right side of the expiration curve and I see what the P&L would be if it expired. And as you can see on the left of the screen over here, as I do this, it's 1750. Well, that's no good. So we've got to make this roughly, say, 5% or less of the margin. So I'm going to have to come in and I'm going to have to reverse Harvey this right at trade launch. Now, when the volatility is a little bit higher, you often can get a butter. You don't have to reverse Harvey at trade launch. But with these days of low volatility, you have to do that. So there's a one lot. So that got us to 1450. So and that is now 11,000. So 1450 divided by 11,000, that's 13%, and we want to get this down to 5. So I know that's not enough. In the interest of time, I know that this is going to be either 3 or 4. And I should say, let me just kind of point out that I do much of this on my own personal spreadsheet. And so I'm going to give you the numbers and the parameters that I would use, and you can devise your own spreadsheet. Maybe at some point in the future, if Tom has some time, which he's always very busy, but maybe at some point he might be able to code these parameters right onto the website. But for the time being, you can make your own spreadsheet. So with the 3 lot, we're down to 850 divided by 13,000, and we get the 6.5%. So we're really close, but we're not right there. So I know a 4 lot will do it. So that gets us to 550 divided by 14,000, and that's 3.9%. So there we are. So there is the initial road trip that looks pretty good. Now we're going to do some other evaluations in just a second, but this looks pretty good. What do I mean by that? Well, our loss at the expiration line at the upper side is now less than 5% of margin, so that's good. We have a pretty flat T plus 0 line going all the way down to the short strike. We're reading $550 of loss on T plus 0. Obviously, we're not going to lose that in one day. So we know this is pretty flat. So now this is the one that I like. And I might have to fix it again, but maybe not. So now I'm going to do some other parameters. And you can make a note of the numbers that I'm going to give you if you decide to program these into your own spreadsheet. I derive these just from empirical observation of doing many of these butters. So the next thing I'm going to do to see if this is really the butterfly that I want is I'm going to set this up on day step curves. And I'm going to want the top curve to be roughly 15 days before expiration. So this is a 30 September. So I could either use 913 as the top or 9. So I'm going to use 913. So now I'm going to focus on the top curve, the yellow curve here. And the first thing I'm going to do is to see if this butterfly is going to generate enough profit to make it even worth putting on. So I find the peak of this curve just by my eyeball. And it's not, it's not going to be the same as the short strike, because remember our short strike here is 2110. So the peak of this curve is at 2125 roughly, and I'm looking at a potential profit of 37.69. So 37.69 divided by our margin, which is 14,000, that comes to 26.9%, and that is okay. My cutoff for this would be 25%. If it is less than 25%, then I don't consider that the butter is actually making enough money on a margin requirement basis to be worth it. But this one is worth it. I like it around 30%, but this is okay. So now what I want to do is I want to see what the risk is on the upside if we keep on going. This is where the market is right now. So I want to see how much wiggle room we have up here, and I want to see what the loss would be if we suddenly went to the short strike. So the first thing I'm going to do is I'm going to see the amount of wiggle room that we have on the upside. And so what I have determined is that a point, roughly 1.5% of the current market, this is going to be the point that I look at. And this is 2207. So I'm going to look at 2207, and then I'm going to go back and look at the yellow line again, and that says it would be $1,136 of profit, at that point on 913. So 1136 divided by 14,000, that comes to about 8.1%, and that is okay. I need to have greater than 5%, so that's okay. So this tells me that the butterfly is giving me enough wiggle room on the upside that I can still probably make a decent profit. And I know that even if I have to reverse Harvey it, which I probably will, then I know I can make a decent profit even if we get way up here. So then the final thing that I want to do, the next to final thing I want to do is to see what the risk would be at the 15 days from now. So I'm going to change the day step to 15 days, and I'm going to find the short strike, which is 2110, and now the cyan colored line is 15 days, and that's going to show a loss of about $81, and I know that that is okay because I have this on my spreadsheet, and I put this in positive numbers, and that calculates to about 0.58%. And I've found that anything less than the 1.5% loss at that point, really maybe a little closer to 1.25%, that tells me that I'm not leaning too long. What I did up here told me I'm not leaning too short. Well, obviously I'm not leaning too short since I'm long delta, but it would be possible, to maybe have delta neutral, but I still wouldn't be making enough money up here on the upside. So what I did down here at the short strike, this tells me I'm not leaning too long, because if I were, these curves would be falling off, and I definitely don't want that. So far this is looking really good. And then the final thing I do is I calculate the position theta as a percentage of the margin, 22.4 divided by 14,000. That comes to about 0.16, and I'm okay with that. Anything greater than 0.15% shows that I'm making enough money in terms of the starting theta. So that's the way. I mean, it sounds sort of tedious, but since I've done this a lot, and I have a spreadsheet, it's pretty fast. And so a lot of times I will throw out the initial butterfly. It didn't pass all the tests, but this one would. So I would take this one if I were putting it on right now. And it's very similar to what we already have on, but we've moved up a little bit. So so you can see, this is the existing strike, but we would be moving up a little bit because we would be having the short strike at 2110 instead of 2100. So I think that's it. Were there any questions on that?
No, Brian just said, Dan, great explanation, and Mike says this is really helpful. Thanks for the extra time. So many thanks, Dan. A good explanation of how you evaluate trade entries.
Well, you're welcome, everybody.
All right, so let's wrap this up. Thanks everyone for the Q&A this month. It was a good one as always. We'll have another one about a month from now in August, but we'll keep doing our weekly videos and keep participating in the forums and the new chat. So thanks everyone, and Dan, really appreciate we're all working together to try and make some money from the Mr. Market.
Well, same here, Tom.
All right, we'll see everyone next time.